Good morning. Hello, everyone. It's a horrible dark morning, isn't it? Dark and wet. I think summer seems a long time ago, doesn't it? So thank you for joining me here today for this webinar on gifting down the generations. We are recording it, so this will be available. We'll upload this to the website, so it'll be available after today's session. But thanks for people for getting up on this horrible dark morning to watch this session live. I am Richard Higgs from Harold Stevens. We are local specialists in dealing with clients in later life with financial planning issues like inheritance tax, estate planning, investments, pensions, care costs, all things related to financial planning for later life. I'm sure you've seen us on the high street in Westbury-on-Trim. And today I wanted to talk about what you can do when you've accumulated all your wealth. Perhaps you have spent all the money that you want to spend, and now you're looking to gift money to the family. You might want to help some of the family with what they need to do at their time of life. And so today I'm going to look at some of the options that you can look at for how you can gift assets, your wealth to the family in lifetime. There's a sliding scale really of simplicity all the way down to more complex type arrangements, and it really depends on where you sit on that scale, really, of simplicity but no control, all the way down to complexity, but you have much more control and perhaps tax efficiency. So I'm going to run through a few different options that you can look at. If you want to ask any questions, you can do in the chat function. If not, just let me know any questions that you might have, and I'll get back to you with an email after today's session. So the most simple thing you can do is an outright gift. So that's a simple gift to a family member. So you take £100,000 out of the bank and you gift your son Johnny £100,000. That is the simplest way, obviously, of making a gift. And lucky Johnny, he's got the money. The money's outside your estate. If you survive 7 years from that gift, then that money is outside your estate for inheritance tax purposes. So great. That's a way that you could gift money. But there's no control over that. And that is full of the risk that Johnny spends the money or wastes the money or gets divorced or life happens and that money just disappears. There's no control over that £100,000. You can't get the money back if you want it. You've basically just given the money away, and you've lost that money. You lost control over that money, I should say. So gifting money is the simplest way, but you lose assets, lose control over those assets, and it's subject to the risks of life, I guess, that money could just kind of be frittered away. You can also gift an asset directly away. So you like a holiday home, for instance. So you've got a holiday home in Wales that you want to gift to Johnny. You could do that in the same way. But remember, that is subject to tax. So you would have to... Oh, morning, James, that's fine. So just my staff member just popped in there. So yeah, all right, see you in a bit. So you could transfer a holiday home, I say, to Jimmy, so Johnny. But remember, you have to account for tax on that gift, even if there's no consideration. So if you spent, say, £100,000 on that holiday home in Pembrokeshire, but now it's worth £500,000, you would have to account for the capital gain on that gift regardless of the fact that there's no actual cash being changed hands. So there would be a capital gains tax liability that you would have to account for on that gift. So it's not just as simple as gifting an asset away. In the same way, if you've gifted that asset away to Johnny, Johnny could do what he wants with that property. If he was to want to buy another property, so sell that property and then buy another, he would have to account for stamp duty on that new purchase. So that's another tax consideration to take into account. So you can make outright gifts. That's, in summary, a simple way of gifting assets outside your estate, giving it and helping people in your family, give some of your wealth. But you do have to take into account the lack of control, the risks, and the tax consequences of doing so. The second thing you could do is use a trust. Now, trusts are there for really you to give assets away from your estate and help family members, but still maintain control over those assets. So you could gift John, your son, £100,000, but instead of him receiving that money outright, you could gift that money into a trust, with Johnny being the ultimate beneficiary of that trust, but you could appoint yourself as a trustee of that trust. So that gives you complete control and management of that money. You decide who gets the money. You decide when they get the money and how much. You have control about how that money is invested and managed over time. So that really eliminates any of that risk of the assets being frittered away. It eliminates the risk of third parties gaining control of that money on a divorce or care costs. And so that helps with you controlling. Sorry, you can come in. I'm doing a video, but you can come in, that's fine. That's Laura coming in. That's the downside of doing a breakfast webinar. So yeah, so just talking about trust. You could gift money into a trust, and that means that you still gain control of that money, but gets that money outside your estate for inheritance tax purposes. So really, we do this all the time. It's a really useful arrangement. So in effect, for inheritance tax purposes, as long as you live the 7 years, you get yourself, those assets are owned then by the trust and not you. So it can be a really effective strategy of getting assets outside the trust for inheritance tax purposes, but still maintaining some control over those assets. So a really valid strategy. I just wanted to let you know 2 or 3 things to be aware of when doing trust planning. So effectively, it's capped, trust planning is capped at 325,000 now each, before you have to pay a lifetime additional tax charge. So in terms of monetary values that you can give away, we're talking 325,000 per person. So for a married couple, that would be 650,000. So that's one thing to mention. Also, some people think that because it's invested in a discretionary trust, on the divorce of a beneficiary, those assets would be protected from the spouse that's divorcing your son or daughter. Whilst that may be the case legally, in terms of a discretionary trust, there's no legal entitlement for the beneficiary. We have to look to see what's actually happened in practice and in terms of the running of the trust. So for instance, if you've written a letter of wishes alongside the trust, and then you've basically said that, Johnny, I want all the money from the trust to go to Johnny. Well, in that scenario, in terms of a divorce settlement, the judge will look at that and think, well, actually, the underlying motive for that trust is for the assets to go to Johnny. And that would mean that the spouse would have access, equal share of that trust property. And also what happens in terms of the running of the trust. What did the trustees actually do in practice? Did every time Johnny asked for the money, did you just give Johnny the money? Did anybody else benefit at all from the trust? Because if in practice, the only person that's ever benefited from the trust is Johnny, and it even says on the letter of wishes that Johnny is to benefit from the trust, then it will probably be the case that the judge will decide that those assets are entitled, Johnny is entitled to those assets, and those assets could then be split upon a divorce of Johnny. So just be careful about how you actually run and word that trust, and take advice on that. Also, in terms of tax, I just wanted to touch on the common misconception that by moving money into a trust, you save all inheritance tax. True, you're saving the very punitive 40% tax on your assets when you pass away, if you're over the your own individual threshold. But there is a 10-year tax charge to pay on any assets that are above your nil rate band after 10 years of 6%, which is effectively 0.6% per year. So it is an additional tax that you just need to be aware of, that you may, under current legislation, have to pay as a family under current trust tax rules. And also remember, trusts themselves are taxed at the highest possible rate for income tax, capital gains tax. So the trusts themselves have to pay tax. There are obligations from the trustees to register the tax now under current legislation, keep the trust register updated with the current position. And there's ongoing obligations in terms of tax accounting and regulation for a trust. So none of those are insurmountable, and you or your advisors can certainly take care of those obligations. I just wanted to let you know of some of the things to be aware of when setting up a trust. But despite that, they are very, very popular, and we do that all the time, setting up trusts in terms of moving money to future generations, setting up trust funds for family members for the future, and escaping very punitive inheritance tax charges down the line. The third option you can do is a loan. So a loan might be where you want to help a family member, perhaps with a house deposit for a grandchild, or do something to help them where they are in their life just now. But you're not interested in out-and-out inheritance tax planning or getting money outside your estate. You still want control over that money. You still want the money back at some point. So you make a loan to Johnny to help him with a house deposit for him to buy a house. So that's great. That's another possible thing you could do. The only thing I would say with that is definitely take advice, and everything has to be documented. So we're talking, if nothing, you can't just say that you've made a loan to Johnny, because it could definitely be argued down the line that it was a gift if there's no documentation. Remember, lending is a highly regulated industry. You need to have it documented, terms of the loan, interest payments, repayment terms, what could happen if something goes wrong. Everything has to be documented onto a loan agreement. So this is something that you need to take advice on and get fully documented if you want to make a loan to a family member. In fact, it's a legal requirement, so a loan. So it's not something to be taken lightly. You can't just say verbally that it's a loan. It's a very regulated and documented process, but it is another way that you can help a family member with financially in lifetime with their needs at their stage of life. Okay, I wanted to touch on a couple of other things. You could also set up a family investment company. Now, this is really getting towards the very sophisticated, expensive arrangements that you can do. We're talking, you'd have to have millions available to set something like this up. And this is basically moving assets and cash into a limited company, and then gradually transferring non-voting shares in that company to future generations, and therefore avoiding some of the tax and trust complicated rules surrounding trusts, but still maintaining control over that company by owning voting shares in that company. So the shares would be split between voting and non-voting shares. You would own 100% of the voting shares, so you still own and control that company with all of your investments and assets in it, but you would transfer non-voting shares into a family member's name and therefore gradually moving those assets outside your estate. This can be done, but as I said, it's a very sophisticated and expensive strategy. So if you are lucky enough to have millions available to dispose of or gift away to family members, definitely get in touch and we will be able to sit down with probably a solicitor and an accountant to set something like this up. But if you're not lucky enough to have that amount of money, but you still want to gift assets away, but still have some sort of joint ownership in those assets, you could potentially gift a house or a holiday home to Johnny, your son. 99% goes to that family member, but you own 1% of that asset still. And therefore, you still have a say. You can still decide what to do with that asset. You still have control effectively of that asset because you still own some of that asset still. So under that arrangement, you'd still have to account for the capital gains tax I told you about if you're transferring a major or all of an asset to somebody else. But it's another way of gifting assets outside your estate, but maintaining that control. So that would be joint ownership, another strategy. So today we've talked about simple outright gifts. That's the simplest strategy, but you lose control and there's tax implications of that. You could put money into a trust, which is often a really effective strategy of gifting monies outside your estates to family member, but still maintaining control. But I've talked about some of the things to consider in terms of trust planning. We've talked about loaning money, lending money to family members, and some of the regulatory requirements around that some of the documentary evidence around that would be required, but still possible. And we've talked about gifting assets away, but owning a percentage of those assets, like owning just a small percentage, therefore maintaining control over that asset, but still being subject to some of the tax rules that we talked about earlier. There's lots of different options. There's pros and cons to each of the options. Nothing's perfect. I would recommend strongly that you come in for an initial exploratory meeting where we can discuss some of these options. We can explore your own situation. A lot depends on your own specific financial situation, the family dynamics. We can explore some of the options in your life. You can ask us questions about what we do as a business. We specialize in this. So this is our daily job. We deal with clients in later life who have wealth, who want to transfer wealth to future generations. So I would probably, as a first step, just sit down with us and just explore some of these arrangements in general, and then we can decide what's best for you, whether it's one of the options, whether it's a combination. As I say, there's no perfect scenario. Probably the most important thing is to really, and that's my job, is to get from you what your main objectives are with your wealth now and going forward, and then we can decide what might be best for your scenario. So I can't see any questions coming through on the chat. I know it's early. Thank you for joining me at this time of day on this dark, wet morning in November. If you do have any questions or they spring to mind, just email me and I will get back to you with an answer as soon as I can. If you find any of this interesting and you'd like to progress one or some of these potential solutions, just, as I said, get in touch and we can get something in the diary here in the office. I'm sure you know where we are. We're on the High Street in Westbury. And I hope to see you soon. Okay, thanks again for joining. We will record this. I think this webinar is being recorded, so we will put this on the website, and so if you can really look at it, if you find any of it particularly interesting, or if you're watching this as a recording, thank you for joining me on the recording. Okay, nice to see you, and we'll catch up with you another time. All right, bye-bye. Bye. Have a good day. Bye. Bye.